to the Gordon Asset Management Podcast, a show for savers, investors, and entrepreneurs, helping you to stay informed, invest wisely, and achieve the unimaginable. Now, on to the show.
Hey everybody, this is Todd Zempel and Joe Gordon with the October 6th market update. Quick reminder, make sure to subscribe to our podcast on Apple Podcasts, Spotify, Google, all the normal places you'd listen to a podcast. So jump right in, coronavirus update. So in the United States, we had 294,000 more COVID cases week over week, trending at about 7.1 million COVID cases. Hospitalizations only climbed by about 560 people, so just fractionally up. The big news, Donald Trump being one of those. So we currently have about 30,000 people in the U.S. hospitalized with COVID. COVID deaths also climbed by roughly 5,000 people to 202,000 deaths in the United States due to COVID. But the big news on COVID is Donald Trump. So late Friday, he went to Walter Reed because he has COVID. Joe, thoughts on this piece?
Well, every day on CNBC or Fox Business, whichever business show you watch, or both, the CEO of Regeneron's been on, which is the creator of the antibody cocktail remdesivir, if that's pronounced correctly. I've heard it a few different ways. And so one of the things I thought was interesting today is he was talking about how the whole notion of antibody cocktails is about getting the immune system to turn on and fight foreign viruses in this case, or cancer. Regeneron's known for doing this with cancer. So it seemed like a fairly natural parallel. He was making that case, and apparently it contributed to working since Trump's now out of the hospital.
Yeah, and again, this is an apolitical discussion, but there's been so much talk about this. I mean, there's folks that are saying this is a big conspiracy theory, that he doesn't really have COVID, all kinds of things. And Trump is clearly defiant against a lot of this. If you saw the film of him leaving the helicopter, walking up to the steps of the White House, yanking off the mask, saluting the helicopter as it flew off. It was all very, very dramatic. And no doubt some of this stuff will go down in the history books. So it's interesting to see it happen live in front of you.
So what happened in the markets last week? Interestingly, it was sort of a risk-on market. The September doldrums were ending as we started the month of October, Thursday and Friday. So you had the EFI, the developed markets outside the U.S., up 0.89% to now only down 7.5% year to date. You had emerging markets, again, dollar weakening a little bit too, up 1.93% for the week, now only down 2.09% year to date. And again, the global bond index, the global aggregate bond, up a little bit, 0.32, now up 5.77% year to date. So kind of a little bit more of the same we've seen since April, other than the month of September. U.S. kind of the same story, a little bit of risk on. The S&P 500 up almost 2%, 1.95 to make it 5.50% year to date. And remember, about 23% of that index is the market cap weighting of the 5 megatechs. The NASDAQ, which is obviously biotech and technology dominated, up 2%, 2.09, now pushing back towards its year-to-date highs at 31.79%. I think it's about 2 percentage points short of that. The big story, though, is the Russell 2000. We've said this every week. In most secular bull markets arising out of a bear market, if it's going to be a bull market rally, you have to have small caps leading. And the Russell 2000 index, which is the representative index for small caps, was up 4.30% last week, almost halving its losses year to date to just minus 5.18. So that's the big news The return on the U.S. Barclays Aggregate Bond Index fell 37 basis points, and the year-to-date returns now 6.46%. So you go back, and we've been started looking at market cap weighted returns versus equal weighted returns, and in this little graph we have in front of us, you can see the big news again. Russell 2000 last week up 4.74%. But then if you look at equal cap versus market cap, the S&P 500 had a much better week over week return than the market cap weighted, and as well as the NASDAQ was roughly the same. So no big news there. FANG with two A's versus everybody else week over week. Again, Russell up 4.74. S&P 500 up 1.30, trailing or forward PE just about 37 times. Facebook up 3% last week. Its PE ratio is 32 times. Google up 1.4%. Its PE ratio is over 32 times. Apple up 1.34. Its PE ratio just under 35 times. Microsoft up 0.45. Its PE over 36 times. And lastly, Amazon up 0.79% last week, and its PE is 121 times. So obviously, Amazon is very frothy compared to the others.
Yeah, so the question here is this the big rotation, or at least the beginning of the big rotation that everybody's looking for, out of large caps into small caps, out of growth and momentum into value? We don't know yet. But it is interesting to see the Russell actually kicking some butt.
Yeah, well, and one thing about the Russell, if you look at value versus growth, a lot of the rally was in the value, and all that is dominated by financials, small banks. So some of that was with rates rising a little bit. Net interest margin will go up, in the hope that there finally would be a rally on the value side. So unemployment, continuing claims fell 810,000 week over week, still a little bit under 12 million, 11.77. Initial claims fell 33,000 week over week to 837. Unemployment rate dipped below 8% at 7.9, down from the peak of 14.7%.
Yeah, so where are all the new jobs being generated? So CNBC recently put out an article on this and had some very interesting charts. And what they have shown is that a lot of the new jobs that were actually created in September were in the areas where there were the biggest losses. So leisure, hospitality, retail. Those are the sectors with the biggest job gains. The biggest loss was actually in government. And one would guess that this is likely because a lot of the folks that were out beating the doors for the census were probably retired, so to speak.
Yeah, they were temporary, and while they were fluff in a previous jobs report, as far as jobs gained, it is short-term in duration. So good to see the leisure hospitality leading the way as restaurants open back up, even in blue states. So how's the consumer spending doing? It's going up still, and there's record amounts of cash on the sidelines. So up 1% in August after increasing 1.5% in July. We expect that to continue. And also, you still have the stimulus bill on the sideline, which is getting closer and closer to a resolution, it appears. At least that's the rumor. Personal income fell 2.7% in the month. A little bit more than economists thought, and basically the decline in income partly explained by lower paid workers in hospitality going back to work, and now that they're not getting their $600 a week federal stimulus, which ended, that obviously is somewhat the reason.
Speaking of stimulus, Fed Chair Jerome Powell is actually doing the speaking circuit today. And the big news coming out of that just today is that he's asking for Congress to basically prime the pump, spend more, stimulate more. And he also said that there's a low risk of overdoing it. So that's kind of been the mantra for a while. Hey, we need to stimulate the economy. We'll monetize it, keep the good times going.
Yeah, I find it fascinating that you're getting advice from a Fed chairman on something that's never happened before in history, kind of like quantitative easing back in 2008, which stopped, and then became infinity when they realized that everyone was addicted to low interest rates and easing. So with that, the budget, our deficit has now exceeded 27 trillion. I heard this morning, 4 trillion of it added this year vis-a-vis stimulus one. So maybe we can top 30 trillion before the end of the year. Who knows? If the Democrats had their way, the stimulus would be over 3 trillion and we would do so. The rumor out there today is that they are near agreement, Mnuchin and Pelosi, at 1.9 trillion. So we'll see if there's any truth to that.
Yeah, and I think some of the run up in the market over the last week was based on the fact that I think a lot of folks are thinking that we will get some kind of stimulus bill.
Yeah, one good thing in that resolution that they're compromise, I guess I should call it, is they're not going to give people $600 a week to stay at home and refuse to go back to work. It's the number's now down, I think, to 400 or 420. Something in that range, which would be very helpful for small business to get their workers to come back to work.
Right. And from an economic standpoint, you kind of have to ask the question, hey, we're just printing this money, giving it to people to not be productive. Perhaps maybe some kind of infrastructure bill or something like that, where we're actually paying people to do work would actually benefit the economy in the long term. Cash versus consumer sentiment. So this is another thing that we keep an eye on. When we look at consumer cash positions year to date, they've increased by roughly 58%. So folks are absolutely holding on to cash, and we see it too. So with our firm, again, we work with individuals, and then we also work with retirement plans. And so we get a lot of folks calling in that are participants in a 401k plan asking, hey, should I move all to cash? Or I'm scared about the election. I don't know what's going to happen with COVID. Should I allocate my account 100% to cash? So we're getting those calls. I'm sure that's a fair sampling of what's going on throughout the country. But when you chart that cash position, the change in net demand deposits in the U.S. versus consumer sentiment, there's an absolute inverse relationship there. So when consumer sentiment falls, people aren't positive about the economy. What do? Well, they tend to pay off debt and hoard cash, and that's absolutely the case. What could be interesting is if we get some real positive developments with COVID and whatnot, the economy starts to turn back on, then we have a bunch of investors that have a whole bunch of cash, and what would that do to the market?
Well, if history's any guide, in 2008, in that financial crisis, a lot of those same investors sat on their thumbs for 3 to 4 years through 2012 and didn't really go back all in until 2013, which was the first really big year of the market after these little snapback in 2009. The market was up over 30% in 2013. So the advice would be don't sit on your thumbs for 4 years until you're sure things are going to do well. So what are we watching? Watching kind of a lot of the same stuff unfold as I think we're less than 30 days to an election that will probably be the most historic election in history. We've got the COVID developments led by the treatment of Trump and released from the hospital. It's not a hospital most of us would ever get to go to. It's probably the Taj Mahal of all hospitals. You got the whole election issue, the postal service, vote counting, mail-in voting. Every state's different. Some governors are getting involved in that now. Stimulus efforts we mentioned, that's going to be front and center, probably resolved this week, it sounds like, as of rumors this morning. The second wave of layoffs, that was to be addressed, and one of the motivators for the stimulus to get the airlines to hold off for a few days while they get their candy from the stimulus, another $25 billion to keep everyone employed. And then you got inflation and money supply issues. Inflation's still benign, but there are a lot of people starting to worry with all this money printing. Something's gonna give eventually. High investor cash positions, which is probably prudent going into an uncertain election. ahead. And in fact, it may not just be uncertain for 30 days. It may be all the way up to January 20th from what we're reading about how contested elections work. And since most people that might listen to this probably weren't paying attention or even halfway at adulthood in 2000 when we had the last contested election, we'll see how it all breaks out. But it's a very interesting way the Constitution was written. And then you got market breadth versus the 5 megatechs. Technology seems to have rebounded from their down September and are kind of creeping back up, all trading at high valuations. The one good thing about the 5 megatechs is they've got fortress-like balance sheets, so pretty strong. And so we'll see. Dollar weakness against the euro. The euro isn't necessarily stronger since they want a money print too. So it's just a matter of the tick for tack back and forth there. And then other than that, this whole notation of a rotation from large growth to small value or large cap to Russell 2000. If last week was any indicator, it is happening, but as we have seen in doing these every week, things can change on a dime, and the following week can be the same. The one last comment I'll make is the VIX, which is a measure of the volatility index. And it seems awfully strange when you had a reflation trade yesterday and market stocks were up big, that the VIX is trading at 28 in normal times. In a reflationary trade environment, it would be at 18 times or even less. So something's not right there that it would be at 28. It may be a warning sign that there is much more volatility coming, which probably is the case with the election.